What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello everyone, I'm Charlie Tchetchenian and welcome to the Advisor's What's Making Headlines podcast. For this week, it's been a very busy week of news and headlines here for us on the Advisor and Broker Daily. I'm your host for today, our editor, Annie Kane. She's earned a well-deserved break. She's off on a road trip. I'm sure she's having a great time, but it was a busy week for all of us here. Julian, Ben, how were your weeks and what were you reporting on this week?
Yeah, great. It's been a busy week, as you say, Annie's, and well-deserved day off. I'm glad to still be here, trucking away.
Holding down the fort.
We've had a variety of really interesting bits of news come through our desks this week. I'm sure we're going to be unpacking a few of them, obviously, from the Broker Daily side and, of course, Advisor as well.
Absolutely. And what about you, Ben? How's your week?
It's been pretty jam-packed and it's been busy this week with reporting season as well. So we've seen a huge amount of stories come out and some other interesting stories as well. Yeah,
there were some unique ones which were always good, but definitely the predictable results that are always coming in about this time. February.
Bit of a baptism of fire for you, Charlie.
Yeah, no. Once you do one, the rest sort of come along organically, which is good. Yeah. Julian and I had our first results with CBA. Was it last week or the week before? It was a couple of weeks ago.
Last week, yeah.
But that was a good start to get into things. A lot of data to pack through. And yes, as you say, results season was in full swing. We had a mix of first quarter updates, half yearly and full year financial results from a range of aggregators, non-bank lenders and major banks as well. And I took a lot of those on. Well, I took majority of those on. In fact, probably all of those on at the Advisor. And it was really good to see what was happening. There are a lot of common trends. Let's start with Pepper Money. They released their full FY25 results yesterday. And I spoke with CEO Mario Rahayem about that. There were a couple of major takeaways from these results, guys. And that was that as we saw last year, prime lending is up at the non-lender, which is very interesting. Prime mortgage originations made up 4.9 billion of the 6.8 billion resi and commercial category, up from 2 billion. So that's a $2.9 billion yearly increase. That's a lot. 148%. That startled even Annie. And I spoke with CEO Rahayem yesterday, and I pressed him on that, but he stressed that Prime was, still firmly aligned with the lender's heritage, and he explained that the Prime products that Pepper offers are very different to what he called vanilla style lending at the banks. What do you make of this trend, Ben?
Well, it's not so much a trend; it's kind of the proposition. The sort of helping those borrower subsets such as self-employed borrowers. And I think you got a really good comment for him when he's sort of breaking down that distinction where it's not your typical prime that you'd normally think of when you think of another lender like a major bank or something. No. He did say the volume was sort of heavily tilted and focused on self-employed borrowers. But as you said, it's super interesting to see that such a substantial increase in 1 year. And,
very much so.
You had some really interesting points as well about broker flows and white label products too.
I did. So it obviously wasn't a massive shock that 95% of flows are coming through the third-party channel. Pepper basically exclusively operates through broker, whether it be retail or third-party. But that is holding strong. And again, Mario basically underlined that they started the business. They had their 25th anniversary last year. It's now 26 years, and basically stressing that the lender is agnostic whether it comes from retail or white label. The broker is very willing and enthused to do business with brokers. And we've got record growth profits overall anyway from Pepper, but brokers at Pepper are, according to the lender, more productive. They're bringing in more income. They're bringing in more loans as well. And he said this was due to the lender offering more products and changing that up for brokers as well.
The other interesting thing that came out in your story was the growth in their Pepper's self-managed super fund, or SMSF mortgage product, which launched in the second half of 2023. And Pepper said originations grew 106% on the prior year, and contributing to about 7% of the total mortgage segment in FY25. So that's pretty big.
A very big result, and Sia Rahayam highlighted how quality products and design were successfully landing with the market. He spoke that there was clearly a real demand for SMSF lending, as obviously the major banks are pulling out. There's hardly any players left. People are really looking for creativity and offerings through SMF. That's really clear. And on from that, SMSF is up, asset finance is up, and profits are up. So in addition to mortgage originations rising, and brokers making up majority of the channel, it's a pretty standout result on all sides here for the lender. And whilst we're on that, the other big story of results was AFG. On the result front. AFG record year, massive year for the aggregator. Residential settlements rose 19% to just under 38 billion, and I think more importantly to this, the majority of that came in the last quarter alone, with $31.6 billion being lodged in the December quarter alone. That's massive.
So it's the highest quarterly figure in the group's history well, which is pretty big.
So that took me by surprise, and their loan book is up as well. But I think the story and the takeaway from this, it pairs a little bit with Pepper's as well, less to an extent, but with more so the SMSF, is that proprietary products are accelerating, and that's through their AFG securities and the AFG home loans as well. White labels are down, but securities are up, and that's complementing and bringing in better profit margins as they sell their own offerings through their securities product. The AFG securities settled $2.53 billion of residential volumes in 1H26, a 26% lift. And the bank that said this was contributing to, shifting the earnings mix, and providing more kind of stable profit margins for them.
Yeah, because AFG is one of the biggest aggregators, I think. Like they always pull out one of these stats in their results. In the most recent one, they said 1 in 9 residential mortgages in Australia is now written by an AFG broker.
Yep.
That's incredible.
And they sort of unpacked some of how its network was growing as well, which is something you touched on in your story too. I think AFG said their broker network increased by 4% over the half. So there's approximately 4,300 AFG brokers out there now, with 91 new brokerage groups joining the platform. But it's massive. And I think they sort of alluded to a strong January as well with plenty of lodgements in the pipeline.
They did the forecasts. The forecasts are looking strong. They in their outlook section, they basically said that resi lodgements in Jan were up 23%. So I think if we're taking that, we're going to have a pretty similar result.
in terms of lodgements, something we looked at in Broker Daily is the kind of breakdown across the country, and that's been really interesting. I mean, it's kind of reflected trends that we've been reporting on for a while. So Western Australia really kind of led the pack there. The Western Australia lodgements grew 12.4% quarter on quarter and 37% year on year to reach 4.52 billion.
Was that the most out of all the states, or?
It was the biggest growth. Okay. Yeah. Obviously, it lags behind. New South Wales is still the largest market nationally at 9.92 billion in the last quarter. Although volumes have slipped there actually by about half a percentage point over the quarter. But still higher year on year, 19% higher year on year. So overall, it's still the national picture is still a very strong picture.
Very much so.
But when you look at the states, you can really kind of see those kind of housing market dynamics play out there.
because as we know, home prices in Perth are skyrocketing. They've just hit the $1 million mark as well. So that's a hot market and a growing market, and they're competing with the Eastern capitals as well.
Particularly, and investment, as we know, is going very strong there as well. So.
Yeah.
Absolutely.
So leading on from that, obviously AFG and Pepper were the biggest stories for us on the advisory results. But we also had results from MA Financial, in addition to NAB and Judo Bank and Bendigo as well. So really everyone just slamming us with as much results and stats as possible. We don't want to overwhelm you guys with stats, but obviously MA Financial is a really substantial player here. They've got MA Money, which is their non-bank lending residential mortgage arm, and they've also got their Finsure aggregator as well, which is also owned by MA Financial. And it's really just consistent themes here. MA Money's delivered a pretty strong year. Their residential loan book ended the year at $5.2 billion, up from $2.1 billion in FY24. So that's a 148% increase. And Finsure as well, managed loans climbed to $175 billion in total. That's a 26% year-on-year result. And basically, Finsure providing us with a lot of broker statistics as well. Their network is contributing to increased scale. Apparently, they're servicing 400,000 borrowers nationally through 4,208 brokers. That's a 12% year-on-year rise.
Yeah. One of the really interesting things in your story actually is they sort of gave some figures around broker productivity by the headcount.
Which is good. We don't usually get
working
that.
out the revenue per broker.
Yeah.
So apparently revenue per broker in FY25 increased to $11,700, up from $10,500 in FY24. So that's interesting to unpack as well.
It is. It's pretty incredible. And I think they're plotting expansion as well. AFG also is plotting expansion. Forgot to mention that, but they're seeking to make 35 total investments.
So that's as part of AFG's broker investment programs, which our listeners will know about, and that's kind of like an ongoing thing. But yeah, they're super keen to sort of
roll on out.
Yeah, absolutely.
Less so emphasis with Judo. Obviously, they're a bank that exclusively deals with relationship-led business banking. But business banking is up. That's the theme across Judo and NAB as well. NAB, somewhat one would say, returning to its roots here with business banking. But, business banking is up at Judo.
Combank was also pushing it.
I know that you dealt with that on the CBA story as well.
And Judo's results were for the first half of FY.
They were for the first half.
26.
They were. So it gave us a good snapshot. They said broker flows were remaining pretty central to the growth story. 72% of loans in the half were third-party originated, and 28% directly originated, and the customer base is up, and gross originations are up as well. Just dealing with NAB a bit, I know this is a quarterly update. We had Westpac last week, a bit of a shift here. Westpac saw their broker flow expand, which is a bit of a isolated event with the majors. CBA decreased and NAB decreased as well. We saw that proprietary lending at the nation's third largest bank is holding at 46%. That's up from 41% in 1QFY 25. I should say 39.9%. So that's a pretty steep rise on proprietary lending channels there. And the bank said openly it was highlighting its pivot, and strategy towards proprietary lending for mortgages, and we can see that in the results. But yeah, what do you guys think? Obviously, there's a divergence here. There has to be, and the banks aren't. They're pretty shameless about it, aren't they?
I mean,
I wouldn't position it as abandoning brokers. I think just for these banks, proprietary channel is more profitable.
Yep.
But they can sort of do both. So I think NAB is still
it's
very
right,
interested in sort of supporting brokers.
Yeah.
They're of course going to try and increase proprietary, and obviously they kind of have the capacity to do so. When you might have been with one of the major banks since you're a teenager. It might have been your very first bank account, and to try and move that through, it means that they can get lots of things. We were looking at this the other day on Broker Daily as well in commercial lending, where banks are looking at commercial and business lending, saying, if we can get one, then we can get the business account. Once we get the business account, we can look at asset finance, and it kind of creates this ecosystem where a business is going to exist rather than, picking and choosing the best products for them. So of course they're going to try and lean into proprietary in the resi side of things as well, because it just makes sense for them, really.
Yeah, I think so. But obviously, very topical story for us on Broker Daily and Advisor as well, and we'll be keeping you all up to date on the results. We've got My State Bank today, and we've got a lot more coming over the next weeks and months. So we'll no doubt that this will be a common theme over the next couple of weeks. But we'll take a short break, and we'll be right back. Welcome back. Now, another major story that was dominating the headlines this week, especially on Broker Daily, was the youX hack and data breach. Julian and Annie took this one on and pioneered it through the week with flashes and follow-ups. Tell us what happened and provide us with a bit of a snapshot of where things stand at the moment.
Yeah, absolutely. So it's something we've been following for quite a while. We broke it this week. We also did a podcast on Broker Daily Uncut with Cyber Daily's David Hollingworth, where we fully broke down this, because some of the more technological parts I was less au fait with, but we got there in the end. So to kind of cut a long story short, youX first revealed this on the 9th of February, I think it was. It became aware of claims that made by an outside actor regarding its internal systems. Once identified, the company did say it was acting immediately to contain the issue. But since then, the fintech has confirmed that a threat actor has released data that it claims to have obtained as a part of its unauthorized access. Now, this we broke on Broker Daily, and they gave this statement to us exclusively. The actor has posted on the dark web, not that we've been on the dark web, but we know it exists.
Nice little disclaimer there.
Basically, they've released a preview of the data that they've stolen, and we're talking a lot of data here. So according to the threat actors on the dark web, they have allegedly taken the personal and financial data of 444,538 borrowers, including incomes, debts, government IDs, and home addresses. So a real comprehensive set of data. The the threat actors allege that they have taken 629,000 loan applications, sort of hundreds of thousands of texts between brokers and clients. Now, the preview, which is all they've released so far, they're looking for a ransom on this. They're looking for youX to pay them. They've published data of about 149,000 loan applications totaling 3.7 billion submitted to 93 lenders. But they say that they've got data belonging to 797 broker organizations. Now, I must say, youX is a fintech, Sydney-based fintech. It's used by thousands of brokers, and quite importantly, the third-party technology system of the aggregation group Viking Asset Aggregation. So this can impact a lot of different people here. Now, this is still very much a story that's moving. No ransom has been paid, and youX is kind of looking into this and doing what they can to try and contain it. But it's definitely going to cast a long shadow, not just in terms of what kind of criminal activity that could come after this. The threat actors themselves haven't said how they're going to use this data. They're just going to publish it. So it kind of leaves the door open to who knows what. We were also talking yesterday about how this could really damage the trust within the broking industry. One of the major parts of the broker proposition is that they are this trusted advisor that you can look to with your, some of your most personal data, where they can get the best deal for you and work through your financial position. Now, what happens when all of your data is compromised and you have people posing as your broker? You don't know who's who. What does that do to the industry? It could have a severe impact past the kind of material threat originally.
It's got massive ramifications. In terms of privacy and also security as well, and what frameworks are in place at these fintechs that have got a massive colossal amount of data and some very personally revealing information there as well. And no doubt this would have thrown a spanner in the work for brokers around the country.
Absolutely.
any of the peak bodies have anything to say about it at all? Are they providing advice to their members? Or
there is some advice coming out. We talked to the MFAA yesterday about how brokers can kind of protect themselves, and they kind of talked about several things here. So obviously your classic bread and butter cybersecurity, you know, two-factor authentication, open banking, all these different kind of things. But they also, you know, it's also important to note, be honest with your clients. Make sure that they know that, you know, if you are affected, which I think youX is reaching out to those that are that could be affected. Obviously, this is still alleged. This is still a threat rather than published definitive risk. Obviously, UX has formally notified the Office of the Australian Information Commissioner, as well as the Australian Cybersecurity Centre to know about the breach, and they kind of legally have to do that if the data breach is likely to result in serious harm, which you can imagine. Now, I should quickly just read out a little bit of their statement. UX said, protecting personal information and maintaining trust remains our highest priority. We have implemented additional security controls and enhanced our monitoring across our systems. We are also undertaking further security uplift initiatives to strengthen our environment. We regret that this incident has occurred and recognise the importance of transparency. We remain focused on reinforcing and sustaining robust resilience measures across the organisation, consistent with recognised industry standards and best practice frameworks. So they're obviously moving very fast to try and contain this. It's interesting. The aggregator Viking Asset Aggregation has not dropped them. I think brokers are still working with them. So it's really what happens from now is the big question.
Yeah, what should brokers who feel like they might be impacted or are impacted be doing?
There's a range of resources that they can go to, some run by the governments. There's also some from the MFAA. There's an article on Broker Daily right now, which kind of goes through the advice and recommendations that brokers can kind of do, not just in terms of this specific breach, but moving forward, because as we all know, in the broking industry, technology is going to be a massive game changer, but it also represents a huge threat. So how can brokers use this tech to use different forms of tech to make their lives easier, but also make sure that they're doing it in a responsible way?
Thank you for that update. We're going to take another short break and we'll be right back shortly. Now, shifting to the domain of federal politics a bit, and also policy, which is a bit bizarre and unusual for us on both publications, but nonetheless, we had a new shadow cabinet announcement from newly elected Liberal leader and opposition leader Angus Taylor, who has succeeded Susan Lee as opposition leader. Pretty short-lived tenure from Susan, and yeah, we got on the financial front, we got some new appointments. Basically, you know, in the senior roles of treasurer and shadow treasurer and shadow finance minister, we have replacements. So we've got Tim Wilson, MP for Goldstein. You'll all know that he recently won that back after a small one-term hiatus of Zoe Daniel as a Teal MP in that seat. He is now shadow treasurer and succeeding Ted O'Brien as shadow treasurer. And we've also got Dean Smith, a senator who will be serving as shadow minister to the shadow assistant minister to the shadow treasurer, and on a, you know, for our all our listeners out there on the financial front, we have Tasmanian Senator Claire Chandler, who's now been made shadow minister for finance, who will be succeeding James Patterson. And he will now be chairing defence. So yeah, this is a pretty big announcement. You know, Claire Chandler's only been an MP since 2019, but before that, she's got pretty extensive experience in policy making, having worked at Deloitte's, and I think her role will be centred on, you know, scrutinising government spending. And rolling back some of that spending and deregulation and fiscal management. I know that in press conference that they gave, there was a lot of emphasis on clawing back some of that spending and finding savings where they could. What do you guys make of these announcements? Obviously, the last shadow cabinet was quite short-lived, so hopefully this one will be a little bit more long-standing and semi-permanent.
Yes. Yeah. Well, the other one to pull out as well is Senator Andrew Bragg will take on this sort of the expanded role as Shadow Minister for Housing and Homelessness,
Sure.
as well, and Shadow Minister for Financial Services.
Yeah.
But yeah, I think they're just reshuffling the deck and trying to.
Do you think this will be the shadow cabinet at the next election?
Well, that's the million-dollar
that's a big
question. Will we
yeah.
have Angus Taylor as the opposition leader come next election? Who knows? 2.5 years is a very long time in politics. It's a fast-moving domain. But yeah, for us on the advisor as well, housing is such a crucial theme for us. So it's good to have some consistency there as well. That Andrew Bragg is still the Shadow Housing Minister. I think is also now the Shadow Minister for Environment. Those are two really, high intensity portfolios, especially housing. And I can't tying into housing.
Yeah.
Moving on from the Shadow Cabinet announcement, we had the IMF coming out this week, giving, a pretty not so much a veiled warning, but an open, explicit warning to Labor and the federal government on their 5% deposit scheme or the home guarantee scheme.
Yep.
And the global lender has said and has urged the federal government to rethink its flagship guarantee program. And they also made a number of numerous recommendations on tax reform and housing and supply and whatnot. But staying on that 5% deposit, they said the scheme could contribute to price measures in the near term by pulling forward home purchases while financial conditions ease. And it further highlighted, quote, the critical need to increase housing supply either by fully delivering the promised $100,000 homes or by limiting the guarantee program to the purchase of new dwellings exclusively. And for those of you that don't know, obviously many of you would, our listeners, the home guarantee program, first home guarantee program allows eligible buyers to purchase a home with just 5% deposit, while the government guarantees the remaining percentage needed to access the loan without paying lenders, mortgagee in insurance. And we're getting a lot of data about price increases on the lower end of the market and the exact opposite happening on the higher end of the market, which just shows how much demand there is for first home buyers and accessing this program as well.
Yeah.
What do you guys think? Obviously, this is a pretty highly contested topic, and I know that there was a lot of commentary from brokers when it was obviously this isn't a new policy. It was expanded. It's an expanded 5% deposit scheme. Yeah, October. But yeah, brokers had a lot to say about it and the impacts that it would have. So yeah, what do you guys think? Would you read into this, or should the federal government read into this?
I mean, I think this is one of the themes we come back to quite a lot on the podcast. The big problem is supply, rather than so. I mean, it's great that there's a scheme that can help sort of borrowers access a house more readily when they need to. But yeah, I think the critical problem is supply. The problem is that's not an easy problem to solve.
No, it's not.
That is something. So we obviously, as you said, this has come under a lot of scrutiny. We talked to over at Broker Daily. We did an article recently where I talked to about 5 brokers about this. Some in Sydney, some in Victoria, one in Queensland. Yeah, just kind of looking at it in different areas. And from my my research and my talks with them, I found that the situation is more split than I think that the IMF gives credit. So I talked to some brokers in central Sydney. They said that they've seen house prices at the lower end explode. I think we did see some totality data on this as well. They said that it's actually had knock-on effects for houses outside the cap as well, because it's pushing people up. And it's basically just causing this compound effect on house prices. They're saying, as you rightly said, that this doesn't meaningfully address supply. It's just concentrating more and more demand at the lower end of the housing market. But then equally, I did talk to other brokers, so notably in Queensland and the Sunshine Coast, and also out west near the Blue Mountains, who kind of said, no, this isn't. This is actually a really viable way in. They said that they had a huge amount of interest, and obviously they're having to change their advice and change their strategy with some clients, because these are clients that traditionally have not entered the housing market. They don't have as much knowledge. They have to start the process sooner. That was the main thing that they kind of said to me, is that the process of kind of getting them up to speed about how you get the mortgage, how the scheme works, everything just takes a little bit longer. But ultimately, it is getting more people into homes, and it is starting Australians off with a better start in the housing market. So it's a mixed picture, I'd say, on the ground.
Yeah. And I think it would be remiss not to note Claire O'Neill, Housing Minister's response. She told the advisor that, the IMF's concerns, she basically brushed them off, and she said, the policy, quote, will have a very minor impact on prices, with modelling from Treasury pointing to a 0.6% impact over 6 years. Obviously, that modelling itself has come under fire from mass media reporting as well. But I think it would be important to note here that the IMF wasn't just focusing on the 5% deposit. They were also talking about, I know Euro's story yesterday on stamp duty in WA. They had a lot to say about that. They basically said that we should forego it completely and replace it with a recurring land tax. Obviously, a lot of prospective home buyers view that as a second deposit, as if one deposit isn't hard enough to save for, and they're not wrong, because it is a very hefty lump sum. And there's been rolling coverage about capital gains discount and whether the government will go the mile or whether they won't scale back the capital gains discount as well, as is reported.
That Senate Select Committee concludes next month, I think. So
okay,
we'll definitely be watching.
So
that.
it's coming.
Cover that,
But the IMF encouraged the government in their annual report that they do to pare that back and to contribute any savings made off of that directly into housing supply and housing infrastructure. So a lot of commentary there from the IMF. I encourage all of our listeners and readers to go have a look at that. It's a pretty lengthy report, or alternatively read my article. I went to the effort of condensing it all for you. But that is it from us this week. Obviously, very much result centric, and that'll begin to shift in the coming weeks and months, and start to hit up again in the middle of the year. But thank you very much, Ben and Julian, for joining me today. Obviously, Annie is sorely missed, but not to worry. She will be back next week at the desk and on the podcast as well. Thank you so much for joining us. We really enjoyed unpacking the week's headlines with you all. Do we have a big weekend coming up, boys, or what's the plans?
I think it's set to be a pretty hot one, so I'm going to be at the beach, I reckon.
Nice. Sounds good.
Not too much planned at the moment, but we'll wait and see.
Okay.
If our listeners want to learn more about sort of our stories, what's the best way to get in touch?
Yeah, so if you have any tips for us, or if you've got any story ideas, please be in touch. You can find my email address or Annie's email address on our website, and do shoot through those story ideas and tips, because they really do go a long way. And, it is our job to report on anything and everything happening in the mortgage and finance broking industry. Thank you again for joining us. It's been a great week, a busy week, and we really look forward to unpacking next week's headlines with you all. Bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.